This is Insight with Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian shares edge higher as investors await progress in U.S. trade negotiations with the region. The PBOC saying it will cut reserve requirements and rates in a timely manner as record tariffs cloud the outlook. We'll discuss all this with our expert panel. Goldman Sachs Chief China economist Hui Shan joins us in just a moment, along with Deborah Cunningham of Federated Hermes. Also ahead, India test fires missiles as tensions with Pakistan ramp up following last week's deadly attack in Kashmir. We'll get the views of the former Indian Foreign Secretary Vardhan Shringla. Plus, the Hindustan Zinc CEO will be joining us exclusively with his outlook for India's biggest producer after fourth quarter profit beat estimates. All right, let's take a look at how Chinese assets are faring as Beijing reiterates its confidence reaching its GDP target of around 5% growth. China's NDRC, PBOC and other ministries holding a briefing on measures aimed at boosting growth and employment. Of course, we had the PBOC saying it will cut its bank reserve requirements and interest rates in a timely manner. But if you're wondering and waiting for details on that stimulus, well, no clarity, no further clarity from today's presser. Let's dive into what this morning's announcements from Beijing mean for investors and how they feed into the simmering U.S.-China trade tensions. We have a great panel of guests. Deborah Cunningham is CIO for Global Liquidity Markets at Federated Hermes, which manages over $800 billion in assets. Also with us, Hui Shan, Chief China Economist at Goldman Sachs. Deborah, good to have you with us. I mean,
great to be here.
If you take a look at the CSI 300, it's now in negative territory, reversing all gains. Obviously, investors, again, disappointed.
I think what you see is a continued spout of volatility that comes from not only direct releases of economic information, some of which are maybe a little bit on the positive side, some of which are a little bit on the negative side, but also sentiment, hard data versus soft data. The hard data seemingly not being as bad as some of the soft data, sentiment, confidence, outlook. And what that ultimately means is whether you're in slightly positive or slightly negative territory, not a lot of progress and growth and expectations from a regional perspective.
So how are you looking at the Chinese market? You took evaluations. They're still very cheap despite the recent run-up. Would you be dipping your toes? Is there a reason to be a bit more optimistic?
I think at this point we're still a little bit more reserved. I wouldn't go straight to the optimism aspect of it. We want to see a little bit more progress, a little bit more action, a little bit more clarity. You noted that from a PBOC standpoint, there seems to be an expectation, but not an actual path at this point. So clarity is what we're looking for before we become more on that optimistic side.
And Hui, if you're looking for clarity, it didn't come with today's presser. Yes, over the weekend, they talked about, providing that stimulus that the economy needs, but we're not seeing that today. No details as yet.
Right. I think there are two reasons why we're not seeing a lot of details or additional easing measures. One is that the situation is still uncertain, both on the tariff front and on the impact on the economy front. If you look at the daily freight volumes departing Chinese ports, we haven't really seen sharp declines yet. So I think as a policymaker, they're still gauging the impact and calibrating how much easing is needed. And the second reason is that we just had the two sessions in early March, and there were a set of policies already approved, but not implemented yet. So the focus from today's press conference seems to be implementing the measures already approved in March, maybe accelerating the pace of implementation, and then wait and see.
You talk about how we're still unsure about the impact of the tariffs on China's economy, and hence are pretty reluctant to perhaps announce new stimulus, yet they're pretty confident about getting to their around 5% GDP target.
Yeah, that's an interesting point. I think that tells you, number one, they are projecting confidence in the market. Part of the stability's mandate in the Politburo meeting last Friday is stabilizing expectations. So I think on the narrative on reassuring the market, there is a sense that they want to convey to the market that things will be okay. And the second, I think there is a confidence about Chinese policymakers' ability to ramp up easing in a short period of time. If they do see very concrete impact on the economy, especially on the employment front, we just put out a report outlining that there are 16 million workers involved in making goods to be exported to the U.S. So if there are signs that employment is being hurt, they can ramp up easing very quickly. It shows you that they're confident that the speed of changing direction, the speed of increasing easing is quite there.
Well, we talked about how employment will be hurt, Deborah, but when you take a look at the trade war per se, it does seem like there is a softening from both the U.S. as well as China. Is that comfort enough for investors?
I don't think so. I think we need a little bit more than that. Definitely negotiations seem to be taking place, although that also is debatable whether you're listening to the U.S. side or the China side of the equation. But I think we still need more concrete evidence that, in fact, 145% is not sticking and it's not going to 125%, but something that's more reasonable, something that matches more of what, sort of the negotiations are that are happening with other parts of the world. So confidence is still lacking.
And that is key, isn't it? I mean, when you talk about that rotation out of the U.S. and into Asia, China suddenly missed that. What would it take for China to ride the wave of, out of the U.S. into perhaps Asia or Europe?
I think, again, a little bit more from an expectation standpoint, with the details being, the devil in the details sort of thing. You need to have sort of a pathway forward. And it's hard to do right now because the lead time ahead of what the actions from tariffs are is pretty substantial, and we haven't seen that yet. We haven't seen that in the United States. We haven't seen that yet in China, and yet we're trying to correct policies that, in fact, are not even impacting yet. So I think their number one, time is of the essence, but number two, details is also required.
And also, I think there are lots of moments out there about an economic decoupling, whether or not tariffs are 145% or even just 60%, that decoupling is happening.
It's an underlying trend. As Deborah was saying, there's a headline, 145, 125 versus 54. A lot of numbers going up and down. But I think from an economic fundamentals point of view, you look at the trade imbalance building over the past many years. And this is a continuation, perhaps exceeding market expectations, but a continuation in the trend of correcting that global trade imbalance. Right? In 2024, China's goods trade surplus was almost $1 trillion. If continue every year, China has this $1 trillion of goods surplus. That means other countries has $1 trillion of goods deficit. So that kind of imbalance, how do we resolve it? Sooner or later is going to generate this kind of a volatility and the discussions about decoupling.
How concerning is it for you, Hui, that we saw Xin over the weekend talk about imposing 370% tariffs or taxes on, exports to the U.S.?
Right, the three-digit tariff rates that U.S. and China are having on each other's products are certainly generating a lot of impacts on individual companies, right? For companies that already have operations in other parts of the world, if you already diversify your supply chain in China and outside of China, perhaps you can navigate this a little bit better. Other countries are facing 10% tariff, and China is facing as high as 145. But for a lot of the smaller exporters, that might be difficult. You might not have the global footprint to navigate this. So I think we're going to see impact. We're still in the period where researchers and policymakers observing what companies are doing what. But we think that when you have a more than 100% tariff between the two largest economies in the world, there's got to be some consequences down the road, both macro and micro.
You know, Deborah, China cannot be looked at in isolation. It has a huge bearing on the rest of Asia. Do you see contagion effect in this part of the world? Might, the rest of Asia be catching this cold?
I think there's a bit of a contagion effect. We've seen it start in Japan. We've seen it start in Australia, a little bit from a Singapore, Philippines perspective. I don't think you get to the level, though, based on certainly some of the things that we was talking about as well. $1 trillion deficit doesn't happen with other countries in the world, or hasn't happened with other countries in the world. There may be some spillover, but it doesn't seem to be to the extent that what we're seeing between China and the United States at this point.
Do you see a possible devaluation of the Chinese yuan as a response to U.S. tariffs being imposed on China?
That could be a response. I mean, that seems like that would assist, at least from an internal target perspective, of maintaining and reaching that 5% sort of goal. We're not to the point where others are seeing that yet at this, even though it is a goal of the administration from a Chinese standpoint. So maybe that, in fact, happens. It's not our call at this point, but I could see where it's not outside the realm of possibility either.
Hui, do you see devaluation of the Chinese yuan?
Currencies are by nature relative, right? If we look at where dollar is and how much dollar has depreciated, on a trade-weighted basis, if the RMB and dollar are relatively stable, but dollar depreciated, that means the RMB has also depreciated quite a bit relative to other countries' currencies. So I think for managing currency, the Chinese authorities have proven that they have quite a large tool set that they can tap into. At the moment, again, if you're wait and see, I think stability is the key word here. We're expecting USD CNY to be relatively stable, 730, 735 range. But you want to look at both where dollar's going and then look at the US-China negotiation and bilaterally where the Chinese government would like to manage the currency at.
And we just one follow-up question. We had the PBOC saying that it will cut rates, it will cut the RRR in a timely manner. How do you read that? What are you anticipating in the next couple of months?
Yeah, that is a term that they have been using for the past few months, and it is confusing to some degree to the market participants because when appropriated in a timely manner, that leaves a lot of room for flexibility. And understandably so, for policymakers, they want to have that flexibility. But for investors, that is the more difficult to navigate when they will be cutting interest rates. I would just highlight that in historical episodes, when you see labor markets start to show signs of a softening, oftentimes the PBOC will start cutting rates, followed by other kinds of easing measures. So I think labor market is key to watch. And secondly, I would highlight because PBOC has other types of interest rates, for example, LPR and as well as these relending interest rate. So when they talk about cutting interest rate, it's possible that they cut some, but not the other. So this is a more complicated complex for investors to watch out.
Watch the labor market. Hui Shan, Chief China Economist at Goldman Sachs. Deborah Cunningham from Federated Hermes will be sticking around. Still ahead on Insight, Toyota Industries shares set to surge by the daily limit after Bloomberg broke news of the Toyota Motor Chairman's proposed buyout. An update next. Keep it here with us. This is Bloomberg. Welcome back. You're with Insight. Now, apart from trade negotiations, investors will also be focusing on key economic data from the US and Japan this week to gauge if the recent stability in markets can continue. Traders, meantime, taking some comfort from hopes that the Fed may cut interest rates earlier than anticipated. Deborah Cunningham is still with us, CIO for Global Liquidity Markets at Federated Hermes. Good to have you with us again, still.
Great to be with you.
I'm just wondering, what's the sentiment among your clients? Are they still, wanting risk or not?
Very much risk averse at this point. If you can provide them with any type of stability, so lack of volatility in today's market in any sector of it is very difficult to achieve. But if you can provide some sort of stability, then the risk appetite starts to improve a little bit. But we haven't really been able to do that in most sectors of the market other than the short-term market.
So what are they doing with their capital? Are they putting it under the mattress?
Proverbial mattress is a pretty good place to be at this point. And I think, to date with the Federal Reserve having cut rates less than had been anticipated maybe when they started the process back in September of last year has kept people confident that they can keep it under the mattress or in a liquidity type of product and still earn maybe not the 5% they were earning back in September of 2024, but 4+% in April of 2025 still seems to be pretty substantial, enough for them to keep a large portion in that very, very low risk sector.
Fair to say they're looking at shorter term versus longer term. There's just so much uncertainty out there. Even the longer end of the curve, it's still a big question mark.
When you look at the long end of the curve versus the short end of the curve, 90% of the returns can be currently achieved by being in the 3-year and under sector. And with that comes, basically not even a fraction, maybe 25% of what the volatility is that you get by going out to the longer end. So yes, you can lock in rates, you can look for additional risk in different sectors of the marketplace, but that's not really where most investors, either on the retail or the institutional side, are focusing their efforts at this point.
So when it comes to the equity market, when we talk about U.S. exceptionalism, some say that story is going away. We have the likes of Vardhan saying that the S&P will end at 4450. That's a long way down from here. Where do you stand on that?
Well, we are not in that camp at all. We came into the year looking for an S&P 7000. And as we are to date, we've seen substantial amounts of confidence that is lacking in that S&P 7000, but not a real change in what our eventual outlook would be, which is continued growth and continued striving towards that 7,000. Now, the time frame over which that's achieved and the volatility that's basically in the market up until we get to that point is still pretty substantial.
But the big question really is, why are you still maintaining 7,000? And if that were to happen, if we see the upside, that's going to be in the second half, I suppose.
And what we're basing a lot of that on is earnings. And so far, we've seen earnings from the first quarter come in pretty strong. Most of it's been in the financial sector, but for the non-financial sector, earnings that we have seen so far, at least are on the higher quality end, they've been substantial. And when you look at that then on just a modest, sort of valuation based on those earnings and where those earnings expectations are going, it still gets you to a number that is certainly not 4450, but a higher number with a higher expectation.
But although some say that the earnings estimates are still overly optimistic at this stage.
That is true, and this sort of goes back to the hard data, soft data. The hard data is backward looking and is still very positive and centric to continued growth and continued improvement from an S&P perspective. However, when you look at future confidence, future expectations, and estimates, that's where you get the soft data aspect of it coming in that's tempering where those S&P 7000 are in the crowd.
Deborah, thank you so much for your insights today. Deborah Cunningham of Federated Hermes. And we'll be keeping an eye on shares of Toyota Industries, so far untraded but set to soar by the daily limit. That's after a Bloomberg scoop revealing that Toyota Motor chairman Akio Toyoda is said to be proposing a massive buyout of the company. Let's bring in Bloomberg senior editor Reed Stevenson in Beijing. We know, Reed, that this is not close to being final, but this will be a massive acquisition. We hear that potentially one of the biggest buyouts in the world.
Indeed, and just to set this up with a little bit of background here, Haslinda, Toyota Industries is the original Toyota company. It created looms, automatic looms, more than 100 years ago, and it birthed Toyota Motor, which is now the world's #1 car maker with more than 11 million vehicle units per year. And essentially what this seems to be is with Akio Toyoda, who is the chairman of Toyota Motor, kind of going back to the founding family's original company, if he manages to pull off a buyout both with his family's wealth as well as financing from Japan's biggest mega banks, he will, through Toyota Industries stakeholdings in Toyota Motor and other group companies, get a certain measure of control over Toyota Motor and the group. At the moment, the situation is that, although he does carry the name of the founder and has been chairman and has overseen really, really robust growth in the business, his economic interest in Toyota Motor itself is actually not that high. It's less than 1%. So to a certain extent, you can see this as a way for him to try and rectify that.
This is happening at a time when Japan is trying to boost corporate governance. I mean, an acquisition this big may just come, may just hinder governance in the country.
Yeah, and essentially, it's sort of a bit of a tug of war between these two kind of issues or trends. But, Toyota itself has taken steps to fall in line with Japan's corporate governance shifts. For example, it is indeed unwinding its cross-shareholdings with other group companies, including its suppliers, Aishin and Denso. And earlier this year, Toyota adopted a new board structure in which the majority of the directors are independent. And so, was that the groundwork for this sort of deal? That's hard to say. But essentially, they're not trying to sort of do everything in one go. I think they're trying to balance that in some way. And really the key question here is whether, the larger institutional investors are going to go along for the ride.
You talked about Akio Toyoda himself, Reed. How much is his future being shaped by this acquisition?
Well, he is in his upper 60s at the moment. I think he has proven, that in his 14 years as CEO and then subsequent years, just the past few years as chairman, that he has really guided the group well and has really turned it into a company that is able to sort of navigate the shift to EVs and automation well. It's invested in a lot of technologies. It has a strong cash position, an ongoing business. But of course, it remains to be seen whether that actually, works out. But I think what he's trying to do to a certain extent, if I were to speculate a bit here, is sort of cement his legacy and, of course, the legacy of his family.
Reed, thank you for that perspective. Bloomberg senior editor Reed Stevenson there. Well, still come on inside. The former Indian Foreign Secretary joins us as tensions grow between India and Pakistan after last week's deadly attack in Kashmir. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. We're keeping an eye on Japanese assets as they come back from launch. The yen in particular, front and center. Of course, this currency has been taking its cues from the broader risk sentiment. The BOJ seen standing pat this week, likely to lower its inflation and growth targets. Though the Nikkei 225 right now currently up by 0.5%. We're keeping an eye on Toyota Motor, Toyota Industries on the back of Toyota Industries expected to proposed buying out the company. The proposal values Toyota Industries at 6 trillion yuan. That is a 40% premium over its market capitalization and would represent one of the biggest buyouts in the world. Take a look where we are in terms of Toyota Motor. Currently at 28.12, it is up by almost 5% as we speak. Now, to the top geopolitical stories we are tracking on Insight. Ukraine's President Zelensky says he's hoping for reliable and lasting peace after meeting one-on-one with President Trump. The two leaders sat down for 15 minutes at the Vatican on Saturday ahead of the funeral for Pope Francis. Trump later questioned whether Russian President Vladimir Putin wants to end the war in Ukraine. The White House hopes to broker a peace deal by April 30th, Trump's 100th day in office. And China has declared sovereignty over an uninhabited reef in the South China Sea. State broadcaster CCTV released images of 4 officers holding the Chinese flag on Saturday, standing on the disputed reef. The Philippines has dismissed claims of occupation as fake news and said its own Coast Guard personnel carried out an operation in Sandy Cay to reinforce Manila's jurisdiction over the West Philippine Sea. The two countries have overlapping claims over a series of reefs and small islands in the waterway. And India says its Navy test-fired missiles on Sunday, showcasing its capability to hit distant targets. It came after India said its troops responded to gunfire for a second day on Saturday from Pakistani military positions in Jammu and Kashmir region. Relations between the nuclear-armed South Asian neighbors have been strained after gunmen killed 26 people last week at a popular tourist destination in Jammu and Kashmir. Now let's get insights on the Kashmir conflict with Vardhan Shringla. He's a former Indian Foreign Secretary and a former ambassador to the U.S. Harsh, good to have you with us. Where do we go from here? Are we inching closer to a war between the two countries?
Well, thank you for having me on your show, Haslinda. I would say that what is important is to know that there has been a major terrorist attack in India. A number of people have been killed for no other reason than being at the wrong place at the wrong time and having the wrong religion as far as the perpetrators of terrorism is concerned. Now, what we are seeing today is the reaction to that terrorist attack. But this is not an isolated case. Pakistan has used terrorism as an instrument of its policy for many decades now. You would recall in 2008, we had the horrendous Mumbai attack. That killed a very large number of civilians all across Mumbai. It included American and Israeli nationals. And then in 2019, there was, the Pulwama attack in which a very large number of, our security forces were killed. And at that time, there was international outrage. I think the United States and many other countries were very firm that India had the right to defend itself. And so we had a hiatus. Terrorism stopped for some time. And we thought that Pakistan had sort of, withdrawn from its policy of using terrorism to advance its interests as far as India was concerned. But this attack, I think, has sort of brought back the same concerns that Pakistan is using terrorism. The sense in India is that unless you are able to retaliate, unless there is suitable deterrence, Pakistan will continue to use terrorism and increase the scope of the use of terrorism as part of its policy. And I think that is something that we cannot allow. And what you're seeing today is really a consequence of that action that I think has led to a number of reactions, including Pakistani attempts at diverting attention by opening fire on the line of control.
I just want to put it out there, Harsh, that Pakistan has denied responsibility for the attack. And we've seen reaction from Prime Minister Modi, pretty strong words from him. Let's take a listen to what he had to say.
I say to the whole world, India will identify, track, and punish every terrorist and their backers. We will pursue them to the ends of the earth.
Harsh, what will shape India's response? We know that both sides have retaliated in terms of diplomatic measures. They've issued threats to each other. What will shape India's response from here?
So I think the Prime Minister has made it clear that those who are terrorists and those who are sponsors of terrorism will be pursued. They will not be spared. How that policy unfolds has to be seen. Countries respond to terrorism in different ways. In the wake of 9/11, the United States, attacked two countries, Iraq and Afghanistan. And I think, and Israel has, of course, taken its own steps against terrorism. Many countries across the world have responded very strongly. Here we are saying that we will go after terrorists and those who sponsor them and terrorist infrastructure wherever they exist. If there are, camps that train and support terrorists and, help them cross over the border, then those camps will be targeted. So it is. If you take the last incident, that's Pulwama in 2019, India's policy was to attack some of the camps that were harboring terrorists who were to be sent across the border to perpetrate acts of terrorism. It was a limited strike. This time, I think the response, could be in different ways, but I think India will choose its time and place. It will not necessarily be knee-jerk. And what is important is that it has to be a salutary lesson that terrorism will not pay and that it cannot be an instrument of your foreign policy.
But I guess the question is really, what's the threshold? I mean, if you talk about the response in 2019, 2016, it'll be no less than what we saw then. Is that a fair assumption?
Absolutely. I think, it is not a question of proportionate response. It's a question of what dissuades those who plan such terrorist actions from doing this in the future. I mean, the Chief of Army Staff of Pakistan made a very telling speech a few days before the terrorist attacks, saying Kashmir was our jugular, and he made a number of communal statements. And that gave a sense that Pakistan was planning something on these lines. Two out of the three terrorists have been identified are residents of Pakistan. There are enough indications to, say that they are members of what is the Lashkar-e-Toiba, one of the most wanted terrorist groups proscribed by the UN Security Council. And from all intents and purposes, the way this was organized, planned, and orchestrated, the terrorists have been supported and sponsored from across the border by the deep state in Pakistan. And from that perspective, I think, those who are in the know will absolutely pinpoint their targets and will make sure that, this sort of a policy, as I said, will not pay. So how the response will come it's not possible to say, but it has to be, a suitable deterrence that will not encourage such actions.
What do you make of the timing of the attack, Harsh? Because it came at a time when, U.S. Vice President J.D. Vance was actually in the country for the first time, and it is not the first time that such an attack has happened when a key U.S. figure is in the country. Back in 2000, just a day, I think, less than 24 hours before the arrival of Clinton to the country, we saw attacks as well.
You're absolutely right. I recall when President Trump visited India in 2020, I think it was February 2020, there were, communal violence broke out in certain parts. Certain suburbs of the capital seemed to be orchestrated and seemed to be designed to attract attention or distract attention from that important visit. This time, the immediate, I would say, possibility of a provocation for the terrorist attack might have been the visit of Vice President J.D. Vance. It's an important visit from the United States, and the idea was to not only garner attention, but to show that there were vulnerabilities in India. At the same time, I think on a longer-term perspective, there is a sense that the success of India's policy in mainstreaming Jammu and Kashmir and the people of Jammu and Kashmir understanding that there was a peace dividend, that they were also stakeholders in that process. And with the vast number of tourists coming into Jammu and Kashmir, more than 20 million tourists visited Jammu and Kashmir in 2023, 2024. Every Kashmiri was a stakeholder in that process. So all of these, I think, these actions are designed to prevent, and it has, because tourists have stopped going to Jammu and Kashmir, And that has, I think, been a very great motivation. Besides, of course, India's own growth, economic growth and development, and the fact that India could benefit from a +1 policy. Today, I will also say that Pakistan is a proxy. Their own foreign minister admits that they're a proxy. They do the dirty work for the world. He talks about doing the dirty work for the United States, for the UK. Today, they're doing the dirty work for another larger neighbor. So the issue is that they are, I think, proxies, and they are there to, I think, act as a spoiler. Their utility, lies in acting as a spoiler in ensuring that things don't work, and you have to actually pay them off to ensure that they don't do these things.
Harsh, of course, we know Pakistan will say otherwise, but what do you make of India's intelligence gathering? Why has it been so difficult for India to actually catch and secure those people responsible for the attack?
So 23.6 million tourists visited Jammu and Kashmir last year. And if you can imagine that number of tourists, 65,000 foreign tourists as well. So that number of tourists spreading across, the Srinagar Valley, spreading across Jammu, it's difficult to protect each and every individual. And I think a lot of tourists were lulled by the fact that it seemed to be, Kashmir seemed to be returning back to the days in which people could coexist and cooperate, and even Pakistan would understand that there was no sanctity, there was no benefit to using terrorism as an instrument of policy. They seem to be coming around to the fact that you could abjure terrorism as a policy, and so these tourists, I think, were lulled into a sense of being completely comfortable with their surroundings. So what I'm trying to say is it's difficult to protect each and every tourist. It's difficult for security forces to be in every place. And of course, you also count on the fact that, there was much less support for any such actions within Kashmir. But clearly, this was an act that was planned and perpetrated from across the border.
Harsh?
Yes, please.
Harsh, thank you so much for your time. Harsh Vardhan Shringla, former Foreign Secretary of India. We thank you so much for your time today. Now, coming up on Insight, the CEO of India's largest zinc producer joins us to discuss the company's outlook amid the unfolding global trade war. Exclusive with Hindustan Zinc's Arun Misra is up next. Keep it here with us. This is Bloomberg. Well, India has just kicked off its trading day. It is joining in gains that we're seeing pretty much in most of the region. The Sensex up by 0.4% gains for the other benchmarks, and the Indian rupee trading at 85.36, currently up by about 0.1% versus the USD. We're keeping an eye on the likes of Ambani's Reliance. Of course, it reported better than expected quarterly profit, with net income rising 2.5% to 194 billion rupees. We're also keeping an eye on Hindustan Zinc. It is a beat, and both stocks currently trading positively. Hindustan Zinc currently up by 1.8% as we speak. Net income up by about 46% year on year. Well, speaking of Hindustan Zinc, joining us exclusively is Arun Misra, CEO and whole-time director at Hindustan Zinc. It's the world's largest integrated zinc producer and one of the top 5 silver producers globally. Good to have you with us. Are the gains, is that pace of growth sustainable going forward on the back of what we're seeing in the world right now, that trade war, especially within the US and China?
So fortunately, with the population of India being as large as it is and a sizable middle class being there, and government of India very strategically and systematically continuing to invest in developing infrastructure in India, the whole idea being convert India into a fully developed nation by a time-bound target, making it a net zero economy, and a time-bound target, making it a $5 trillion economy. So those large goals being in place, we are very bullish about our domestic demand. Of course, export does bring in a lot of revenue, but our exports are in the technology, software sector. On the manufacturing sector, India has been a hub of low-cost production. India has been engaging with USA very, very proactively. You must have seen there is no hue and cry in India on tariff. Indian government has also restructured tariff on American goods in a number of cases, very, very proactively. So there is nothing, no panic here. I think Indian economy will continue to grow at the same rate or even better in the coming days with the budgetary expenditure of government the way it has been declared. And we are being in zinc and the only supplier to the steel companies in India, which are eyeing for a growth of up to 300 million tons of steel production in India. So we are very upbeat, absolutely no concern.
Arun, despite the optimism, there are inherent risks. Price volatility, for instance, is one of them.
Price volatility in zinc, I'm very certain that next 2 to 3 quarters, it would be fluctuating between $2,600 a ton to maybe $2,750 a ton. I don't expect it to grow any further. But yes, I am sure by that time, the new supply chain structure across the globe, the tariff structure across nations would have settled down, and we can see some progress towards 2,800 towards the January to March quarter of next year.
In terms of demand, though, how strong do you think the demand from construction will be for you, manufacturing will be for you?
See, of the global 12 to 13 million tons of zinc production, USA consumes only 700,000 tons. That's about 0.7 million tons. Even if the tariff has an effect, the demand in USA cannot go down below, say, another 80% of the current demand. If that be so, I don't see much upheaval as far as demand in zinc is concerned globally. Moreover, we are more so domestic player. 80% of our supplies goes into domestic market, and rest of is in Southeast Asian market, a little bit of Middle East, which are all growing economy, emerging economy, aspirational people, where in all these countries, government is spending huge amount of money in infrastructure. So we are in a very, very safe place as far as the global upheaval is concerned.
Can you quantify the kind of demand you're anticipating in the quarters ahead?
No, absolutely no problem in our demand. We are seeing current books. Our books are full. Even typically 2 years back, we used to sell 45,000 tons in India. Now we are selling consistently over 52,000 to 53,000 tons in India. And there are no dearth of demand as far as India is concerned. There is no dearth of demand in countries like Vietnam, Nepal, Thailand, Singapore, and the Southeast Asia is concerned. We are absolutely seeing very good traction, including Malaysia, Taiwan. Good demands are coming.
Arun, you're not just India's biggest zinc producer, you're also its biggest silver producer. We've seen gold getting to record highs, 3,500 is the level, or hovering thereabouts. Do you see silver playing catch up? Where do you see silver prices headed from here?
No, absolutely. Silver will follow gold. It's a time cycle, and more so the rush for gold because of upheavals in financial market that has prompted a lot of buying of gold to begin with. But as the gold prices shoot, we have always seen that the people's moderate or low income people switch over to silver as the safe bet option for investment. So there is a time lag, but I can see it growing from current $33, $34 a troy ounce to maybe it will go to 35, 36, or maybe $37 a troy ounce, also prediction by people in a 3 months' time.
Arun, we know that Hindustan Zinc is undergoing an expansion plan. It is in its first phase. Talk to us about what will be achieved in this phase and what the other 2 phases will look like.
No, so our expansion plan, broad headline is what we are preparing for is growing by 1 million tons of production. So currently we are at about 1.1 million tons of zinc plus lead production, and we want to make it 2.1 million tons of lead plus zinc production. At the same time, currently we are producing about 700 tons of silver. We want to make it 1,500 tons of silver. The whole idea being is when India grows up to 250 to 300 million tons of steel, they would require so much of zinc, and we having about 33 million tons of metal in ore in our resources, why not convert them and supply them to the market? So that's the whole idea. Maybe it will have some 2-3 phases of expansion, maybe in a multiple of 0.3 million tons of each, and we will do that in a very time-bound and a very, very most cost-effective manner.
What will this expansion plan mean for your profit going forward?
Obviously, if you put the top line with our cost numbers being as low as $1,052 a ton, and next year we are targeting about $1,025 to $1,050 a ton, you can imagine that the fixed cost will be spread over much double the volume. The cost will come down below $900 a ton. So our profits will not only double simply because of double the volume, maybe more than what it is, more than because of the cost reduction as well.
Arun, we also know that you're going beyond core metals. Can you shed some light on that strategy and why that is important?
The government of India is very bullish on critical minerals, and number of blocks are being thrown open for auction in India, which is gold, which is palladium, which is nickel, which is cobalt, which is some amount of lithium, which is potash for fertilizer. So all these molybdenum, so many blocks are coming. We have now got a few blocks on tungsten, on gold, and we will just get into exploration, and maybe another 2 to 3 years time we will start mining them. If the techno-economic feasibility remains in those properties, Hindustan Zinc's future cannot be restricted to zinc, lead, and silver. It has to grow into gold and all other metals, which takes the country into the new economy of renewable energy-based economy, which has huge amount of consumption of metals like nickel, metals like silver, metals like copper, and we would like to take the country to that zone.
So, in a way, it's not surprising that you're returning to the rupee bond market after an absence of 4 years. Where are you with that?
So that's at Vedanta level. So we are at Hindustan Zinc. We are not going there. It's for the Vedanta level as far as financing is concerned. As far as Hindustan Zinc is concerned, we are AAA rated. We have got cash positive company, and absolutely no concern on money as far as we are concerned.
And Arun, before we let you go, these are uncertain times. You're pretty upbeat about the outlook for Hindustan Zinc. What do you deem as the biggest risk for you?
No, our biggest risk has always been transition to the green economy, because whatever individual leaders may say, we understand that the global warming is a reality and the whole world will move towards that. And we have to transition to that area where we produce zinc at the lowest CO2 emission. As you know, we are already certified. 13% of our production is now what is called EcoZen zinc, that is produced at 1/4 the CO2 emission of the rest of it. So we are in that direction, and that's why these are all temporary phenomena that happens with every elections. Yeah.
Arun, thank you so much for your time today. Arun Misra, CEO and whole-time director at Hindustan Zinc. Now, before we go, here's a preview of tomorrow's show. We'll speak with Morgan Stanley Investment Management about opportunities in emerging markets. That's as EM stocks and currencies outperform the US peers in the first 100 days of Trump's second presidency. That is it for Insight. This is Bloomberg.